Hello, welcome to the European Open Briefing for Thursday, February 1st. I'm Rafi Bajan, currency analyst at XM.com, and we're going to be taking a look at the latest developments in the currency markets today. The US dollar is slightly firmer this morning following the Fed's policy decision yesterday, where although they kept interest rates unchanged, they did sound a little bit more optimistic about growth and inflation, and this pushed up US Treasury yields. It also put downwards pressure on other currencies, particularly the euro and the pound, which briefly fell below key levels before recovering again. A notable move this morning is the Australian dollar. It came under pressure after a big plunge in building approvals in Australia. The Canadian dollar, on the other hand, has hit a 4-month high on solid GDP, monthly GDP numbers, and we are seeing a rebound in oil prices following those one-week lows yesterday. It is being helped by signs of strong compliance by OPEC and non-OPEC countries to the output deal. So let's begin now with the dollar. We can see both dollar yen and dollar index have been trading pretty much sideways since the end of last week. Yesterday's FOMC decision, FOMC statement rather, where the Fed was a bit more confident about the outlook. The statement said gains in employment, household spending and business fixed investment have been solid. Economic conditions will evolve in a manner that will warrant further gradual increase in the federal funds rate. This was slightly more hawkish tone than the previous statement by the FOMC, and this helped the dollar recover from its recent lows. You can see dollar yen hit a high of 109.64 a short while ago before easing slightly to around 109.50. The dollar index has managed to cross back above the 89 level. And although we are seeing a big surge in US Treasury yields, the impact on the dollar has been rather muted. So although the dollar is firmer this morning, it's not that much up. And we can see it's not too far away from last week's 3-year lows. So investors will want to see more solid data out of the US to be convinced that the Fed could possibly raise rates 4 times rather than the expected 3 times this year. We've got the ISM manufacturing PMI coming up in the North American session later today, and tomorrow we've got the January non-farm payrolls report. We had an indication of what we could expect from the NFP report tomorrow from yesterday's ADP employment report, which is a private survey which came in above expectations, so that could possibly point to strong numbers in tomorrow's official report as well. Moving on to European currencies now, we can see the euro and the pound are both up this morning, ever so slightly against the US dollar for the euro. The pound is a little bit more firmer though. They both did cross below key levels. The euro fell below 1.24, sterling fell below 1.42 before jumping higher again. Yesterday we had the flash January CPI numbers out of the eurozone. We saw the headline figure dipping from 1.4 to 1.3% in January, but the core rate came in above expectations, rising from 1.1 to 1.2%. So that possibly suggests that the ECB is starting to make more progress as far as lifting underlying inflation. Although we are hearing more dovish remarks by ECB officials, Governing Council member Benoit Cowell yesterday said that we are not going to be too hasty in terms of ending the asset purchases. Yesterday the euro had hit 1.2475 following the inflation numbers before retreating somewhat. The pound, on the other hand, has been boosted this week from remarks by Bank of England Governor Mark Carney at a hearing in Parliament on Tuesday, when he said that as the economy recovers, the focus will move away from stimulatory measures to being back on inflation. And he was overall a bit more confident about the economy, particularly the tightening labour market in the UK. And this has raised the prospect of 2 rate hikes in 2018 by the Bank of England, as opposed to the prior expectation of just one rate increase. Although it's still very the odds of two rate hikes are very low still at the moment. But they could be rising in the coming months. So that's why we're seeing a stronger euro, a stronger sterling, not just because of the weaker dollar, but also because of expectations of rate hikes in the UK. It's a notable recovery. It had hit 1.3977 on Tuesday. It's currently trading around 1.4235. We do have some particular uncertainty with Brexit. Theresa May is set to reject the current offer by the EU of a transition deal because the UK does not want the deal to include free movement of people during the transition period, which is what the EU is proposing at the moment. Let's move on to the Australian dollar now, because the Aussie has come under pressure since yesterday. We had the fourth quarter inflation numbers out of Australia yesterday, which came in below expectations, and earlier today we had building approval numbers, which also disappointed. They plunged by 20% in December. Forecasts were for a drop of just 8%, though we did see a small upward revision to the prior month's figure, but overall the data both yesterday and today have lowered expectations of a hawkish tone by the Reserve Bank of Australia at its policy meeting next Tuesday. The Aussie has now fallen about 1.5% from last week's 2.5-year high of 0.8135 versus the greenback, though it's still up almost 3% in the year to date. We can see the Aussie, the sell-off stopped at just above the 0.80 level. It has now stabilized around 0.8020. Moving on to the Canadian dollar, we can see the loonie has been firming this past week. It hit a 4-month high 1.2246 versus the greenback yesterday. It was helped by monthly GDP numbers, which showed the Canadian economy expanded by 0.4% month on month in November, as expected. This hasn't done much to change rate hike odds for the March meeting, where the Bank of Canada is expected to keep rates unchanged, but it has still been positive for the loonie, because in October GDP growth was flat, and the fact that it did rebound strongly in November, it does suggest that the economy is back on track and not headed for an unexpected slowdown during the fourth quarter. Plus, the 6th round of NAFTA talks ended a bit more positively on Monday. There were some signs of progress, so this has also been positive for the loonie. And finally, taking a quick look at oil prices, we can see WTI fell to 1-week low yesterday, slipping below the key $64 a barrel level. Brent crude fell below the $69 a barrel level. The reason why oil prices came under pressure earlier this week is because of signs that US inventories, as well as inventories in some other countries as well, have started to go back up again for the first time in many weeks. This is mainly due to the peak winter season coming to an end in the Northern Hemisphere. We saw a big jump in US crude stocks last week, as well as US output hit 10 million barrels a day for the first time since the 1970s. So all of that came out yesterday, but it was pretty much anticipated. That's why prices actually fell prior to the data, and then they reversed higher, and that recovery was helped by a bigger than expected drop in gasoline stocks in the US last week, as well as strong compliance by OPEC and non-OPEC countries. The compliance rate rose to 138% in January, indicating that output was cut by more than required. We can see WTI is now attempting to go back about the 65 level. And finally, looking at today's economic calendar, we can see the data already released there. We also have some UK house price data which beat expectations. Eurozone final manufacturing PMI reading came in unrevised at 59.6. The focus later on will be on US weekly jobless claims and, of course, the ISM manufacturing PMI. That's it from me. Thank you very much for watching, and have a great day.